Welcome to This Explainer. Today, we're pulling back the curtain on the hidden profit engines operating right beneath your everyday financial transactions. You know, when you look at the macroeconomy, you aren't just looking at money changing hands. You are witnessing an absolute masterpiece of engineering, completely optimized for the sheer scale and velocity of global capital. So let's map out this invisible architecture, the matrix that literally runs the modern world. Just think about the global economy for a sec. Sure, there's your standard morning coffee purchase or, paying the electric bill. But at the exact same time, there are algorithmic high-frequency trades executing in microseconds, massive corporate remittances crossing borders, and institutional clearinghouses settling billions. Millions of transactions happen every single second. Whether you tap a card or execute a block trade, the seamless interface creates this incredibly convincing illusion that capital is simply and directly moving from one person to another.
But here's what's genuinely fascinating. Look at the sheer amount of friction extraction happening right beneath the surface of all that movement. Behind every single one of those transactions is a massive financial system quietly earning billions of dollars. And honestly, the most surprising part? Many of the world's biggest and most profitable financial institutions don't make their billions by selling physical products at all. There's literally no tangible good changing hands. Their real product? It's capital velocity. So that brings us to the crucial question we have to ask today. How exactly does this massive invisible network actually generate such staggering wealth? If they aren't manufacturing a physical product or mining a raw material, what exactly is the business model? Well, the answer lies in understanding the financial system as the world's most hyper-efficient toll network, a system completely designed to extract yield from the mere act of capital existing, moving, and being promised.
Okay, here's our roadmap for this explainer. First, we'll look at the invisible financial network. Then we'll dive deep into our main focus today, unlocking the interest spread. After that, we'll cover the hidden cost of swiping, profiting from predicted risks, and wrap up with the business of moving money.
All right, let's jump right into part one, the invisible financial network.
It is definitely time to completely discard that outdated Hollywood notion of banks acting like giant secure storage vaults, the idea that your money just sits there idle until you come back for it. The modern financial system is entirely predicated on liquidity. It's a massive, constantly flowing network designed to put capital to work aggressively. Modern banks are basically central routing nodes, moving capital from where it sits idle to where it's demanded. They make money by moving, managing, lending, and sometimes even effectively creating money through credit. It's a high-pressure river, guys, not a static reservoir.
Which leads us perfectly into part two, unlocking the interest spread. This is the absolute beating heart of traditional banking, and where the most crucial financial engineering actually happens.
Let's fundamentally redefine what a deposit actually is. Say you deposit $1,000 into your savings account. You aren't putting it in a digital lockbox. Actually, on a bank's balance sheet, your deposit is a short-term liability. They owe you that money, and you can demand it back whenever you want. So, to generate profit, the bank immediately practices what's known as liability management. They take that short-term liability, your deposit, and deploy it out into the economy as a long-term asset like a 30-year mortgage or a corporate loan. They constantly have to balance these highly liquid deposits against highly illiquid loans.
And this dynamic right here leads us directly to the concept of net interest margin. When a bank lends out your deposit to a home buyer, that borrower pays a premium. They're paying for the duration of the loan and compensating the bank for the risk of default. Meanwhile, the bank pays you, the original depositor, a significantly lower rate, right? Because your deposit is virtually risk-free and completely liquid. The massive, mind-boggling profitability of banking exists entirely in this deliberate asymmetry between what they charge for risk and what they pay for liquidity.
That gap is known as the interest spread. It's elegantly simple in theory, but incredibly complex in execution. You provide the raw material at a low cost, they lend it out at a higher cost, and they pocket the difference. That spread is the fundamental engine of banking. But it's vital to realize that this spread isn't static. It's highly sensitive to macroeconomic policy. When central banks like the Fed raise or lower benchmark rates, they're effectively compressing or widening this interest spread, completely dictating the profitability environment for every commercial bank out there.
Because this interest spread is often just a few percentage points, sometimes just a few dozen basis points, the traditional banking model relies heavily on leverage and volume. Banks don't just lend out the exact amount of capital they hold. Through fractional reserve banking, they lend out multiples of their actual capital base. By maximizing the volume of deposits coming in and loans going out, and applying leverage to the whole thing, institutions magnify a tiny tiny margin into billions of dollars in highly reliable profit.
Moving right along to part 3, the hidden cost of swiping. Let's look at the friction hidden in everyday transactions.
When you tap your credit card for a coffee, the millisecond journey of that payment feels completely seamless. But behind the scenes, you're triggering this incredibly complex cascade of digital handshakes. Your tap instantly communicates with the acquiring bank, representing the merchant, and the issuing bank, which gave you the card. Connecting them as the payment processor and the massive card network, acting as the digital rails that securely route the authorization and settle the funds.
And the toll for using these rails? That's the interchange fee. Every single time a card is processed, merchants pay this fee, which gets sliced up among the processors, networks, and banks. It's so ubiquitous that merchants effectively just bake these fees directly into the cost of their goods. Which means, crazy enough, cash buyers are often subsidizing the lucrative rewards programs enjoyed by premium cardholders. But the network toll is just the beginning. The real cash cow for issuing banks is revolving debt. While the card networks run a low-risk toll booth model, the issuing banks run a high-risk lending model, extracting massive yields from consumer interest when those balances aren't paid in full.
Honestly, the psychology and user experience of modern finance are ruthlessly optimized for this. Features like one-click checkout or Apple Pay are specifically designed to reduce what they call payment pain. By making spending entirely frictionless, financial institutions intentionally increase transaction volume to capture more interchange fees up front, while simultaneously increasing the likelihood of revolving balances and hefty interest payments on the back end. Now for part 4, profiting from predicted risks. Let's shift gears and look at the insurance industry.
Insurance completely flips the standard financial script. It relies heavily on actuarial science and the undeniable law of large numbers. By collecting manageable monthly premiums from millions of people, companies build this massive pool of liquidity. They do this knowing, statistically, through insanely sophisticated risk models, that only a microscopic fraction of policyholders will ever file a major claim. Insurance is essentially the business of pricing risk accurately enough to mathematically guarantee a massive pile of leftover cash.
But the true masterpiece of the insurance model is a concept known as the float. This famously happens to be Warren Buffett's absolute favorite engine of wealth creation. See, insurance companies are essentially massive investment funds that get paid by their customers to hold capital, rather than having to borrow it. Because they collect premiums long before claims are paid out, they have years, sometimes decades, to invest that float in the market. They generate staggering investment returns on capital that was never truly theirs to begin with. Finally, part 5, the business of moving money. Let's see how all these pieces fit together.
The financial system isn't just a bunch of isolated silos. It's an overlapping web of fee extraction and yield generation. Banks capture the interest spreads on loans, which, as we discussed, is the massive baseline engine. But those same banks issue the credit cards that run on the global networks, harvesting interchange fees. They cross-sell insurance products, generating float, while their investment arms collect management fees. Every single payment, loan, or policy fuels another sector of the ecosystem. It's this closed-loop environment where everyone takes a tiny slice of the pie as capital routes through their specific node.
This quote really hits the nail on the head for today's explainer. Contrast this business model with traditional manufacturing. A car company wrestles with physical supply chains, warehousing, and inventory. A financial network scales digitally. Momentum is literally their merchandise. They generate revenue with near zero marginal cost per additional transaction, making capital velocity the most scalable, profitable product on earth. So the next time you tap a card, secure a loan, or pay a premium, recognize the architecture at play here. You aren't just a user of this system, you are both the customer and the inventory. Your deposits, your daily consumption, your willingness to take on debt, these are the literal raw materials that fuel global finance. Your everyday actions keep this highly optimized multi-billion-dollar engine turning. Which leaves us with a final thought to ponder. When you transact, are you merely moving money from point A to point B to get through your day? Or is your capital actively turning the gears of the world's most profitable, invisible engine? Thank you so much for exploring this fascinating system with me today. Keep asking questions, and I'll see you in the next explainer.